All right, going live. So we're here.
Hello, hello. Happy Wednesday. Hi, Chris. How are you doing today?
Amazing. How you feeling?
I'm feeling good. I'm feeling good. It's good to be back.
Good. Good to be back. Good to be back. So you had a good week?
I had a good week. I had a good
Yeah,
week
I
and a
did.
good week.
I did as well. We had a good week. Last week was I was actually in Dallas this past week from like Thursday to like Monday. I was at Tony Robbins event. So that was pretty good. It was interesting.
Okay.
Yeah. So that was good. Always good to be around some like-minded people, right? Learning
Mhm.
and growing. Yeah. So if you haven't went to one of the events, it's actually really good. It's kind of intense. It was like almost like 50 hours, right? We're there almost like 12 hours a day. Yeah.
Oh,
So it was
that
pretty
sounds
crazy.
very
Yeah.
intense.
Yeah, but it was good. It was good. It was good. So yeah, so I'm excited about today's show, kind of like a follow up from what we did last week, just like a
Yeah.
part two. What some of the things that we went through for preparing for this upcoming year. So for tax planning. So I'm Christopher Bush, your financial advisor.
I'm Abby Joseph, your tax strategist, and welcome to another episode of Redline.
That's 100. That's 100.
Good deal. We back.
Okay, so I'm being told to ask, did you walk on fire too?
Oh yeah, I actually did walk. You said somebody
You
asked in the
did?
comments. Yeah, I actually did.
How was that experience?
uh, Yeah, who else? Somebody else was there. Okay, yeah. I saw Wall Street Trapper. He was there. One of my couple of my business partners were there. I actually brought my sister. It was like 12,000 people there. It was kind of crazy. Yeah. So I would say the walk on fire part was fine. What
Mhm.
was harder than a walk on fire was actually walking to the walk on fire portion of it, right? So we had to take off our shoes and socks and from the convention center, right, and walk outside. So it wasn't just like a normal walk. It was raining. The ground was completely wet, right? You got
Mhm.
rocks and everything you got to step over. So by the time we got to the fire, we actually needed the fire just to warm our feet down, right? Because it was like so cold. It was cold out there and walking through water. I'm like, why are we out here barefooted, right? Trying to walk on fire. Like we could have took our shoes, right? And
Mhm.
took off our shoes when we were there, but now we had to leave our shoes back. So it was a interesting experience just walking to
Yes.
it.
Ooh,
Yeah,
that's
so it was cool
awesome.
though. It was really,
That's
really good.
awesome. Very good. Well, I'm glad you had a good experience.
Yeah. So it was good.
I've never been
So
to one.
so where should we start tonight? Where you want to start off from?
Okay, let's start back. So last week we talked about high income, right? W-2s and how they can save in their taxes. We said, hey, listen, look into adding more to your 401k, to your 403, to your HSAs, right? What else did we say? We said look into health expenses that you had last year, dental, but we also talked about the standard deduction and we talked about
Oh,
itemized
no, that's
deduction.
seduction. Yep.
And we went over how sometimes if your personal expense does not max out from the standard, it's usually best to just use the standard deduction.
Yeah.
So we did go over the high income of W-2s. So tonight we want to kind of go over, okay, what if you are a W-2 and you are a business?
Yeah. And
So
I think
yeah.
one thing maybe you could kind of touch on a little bit, or maybe I think whether you are a high income earner or W-2 employee, you may run a business. I think the other portion of it that we didn't talk a lot about, and I think this may be like again another topic for a following week, just to kind of get maybe we kind of can bring on a guest to talk about this, but I really think what's important is understanding on the real estate side how that can play, right? So we understand what we're going to cover a lot about what we can do from a paper asset standpoint, right? When it comes to lowering your tax bill, tax planning. But I know for me, like I actually had I had a tax planning call with my one of my tax planning team, And
Mhm.
one of the strategies that we're going to be using is, we're going to be, I need to buy another short-term rental before the end of the year, right?
Oh, mhm,
So I think that's another good strategy to kind of discuss. If you do have a high income, you do owe taxes, and you have cash on the side that you say, okay, I do have enough money in my financial plan, to maybe even looking at to buy a short term rental property, right? Again, in order to qualify as a short term rental, the average stay has to be, around 7 days, right?
mhm.
So
Yes.
you can kind of fulfill that by the end of the year if you have a couple people to go ahead and stay. But I think that's also another strategy that people can utilize. And just don't, there's multiple ways that you can look at your financial plan. So we talked about a lot of the paper asset standpoint, but that's why also real estate plays a big portion when it
Yes.
comes to depreciation, when it comes to using short-term rentals, not a long-term rental, but a short-term
Mhm,
rental
mhm.
into that place. But Abby, I don't know if you want to speak on that, or maybe we should bring on a guest to kind of talk about that portion of the short-term rentals and stuff. What do you think?
Well, one of the great thing about with short-term rental as well too is that not only does you're able to write off the expenses on the rental property, but you can also depreciate the property, right? And depreciation is such a huge benefit when it comes to tax savings. So if we're looking at a high income and you want to do short-term rental, it is a great way to save. I know I have a colleague of mine that really focus on real estate, on the real estate side, and I don't mind. I would love to bring him in here for you guys, and he could talk about the sales. He could talk about how IRS sees short term rental. My favorite is the 14-day. So what I like about the 14-day or less a rental for you could use your primary resident, like say for an example, when I go to New York, I usually stay with one of my girlfriend's house, right? And I can pay her instead of an Airbnb, or instead of staying at a hotel, I can actually just stay at her place, right? And I could pay her for 14 days. She doesn't have to use that as income, and I can use that as a deduction. So
Yeah. So okay, so talk about. I mean, that's the Augusta rule, right?
yeah, that's the Augusta rule.
Yeah. So again, so, somebody saying that he talked about some business strategy. I think that's super important to understand, right? If you have a business, kind of go back through that a lot. I don't know if anybody missed it, but it's yeah, I believe that's called the Augusta rule. Make sure I'm right
Yeah.
on how that works, because and how you go about finding the marketable rate of what you can rent out your place for. Because yeah, if you have a place, have a home, you can rent out your own place
Mhm.
for up to 14 days out the year, right?
Yes.
But and you can do it. So kind of talk about that a little bit more. If not, I can kind of fill in as well. But yeah, go ahead.
The Augusta rule is really simple. You can use your resident, right, as a part-time rental. So what I usually like, even with my friend that I stay at her place in New York, I would say, okay, what I usually do is I would look at the Airbnb and how much it would cost me, or how much it would cost me to stay at a hotel. Let's just say right now, I have to be in New York in December, right? I have to be in New York in December 9th. And I'm looking at the hotel that I usually stay at in New York. They're literally looking at $900 a night. That's ridiculous, right? And I don't want to pay $900 a night. And I'm looking at the Airbnbs, and I'm looking at what the prices the Airbnbs at. So I could say, hey, Jessica, I'm coming to New York. Can I stay at your place, for the next 10 days or the next 2 days, whatever the amount of time. And I could tell her, hey, listen, I'm going to pay you, right? I'm going to pay you just like I would pay an Airbnb, just like I would pay for my hotel. I'm going to pay you for those time frames. And with the Augusta rule, the benefit of it is more on my side as the business, but the benefit of hers is she's obtaining cash as well.
Absolutely.
So I pay her in the business end, it's a deduction, right? And her end, it's income, and she does not have to write. She does not have to. She does not have to actually add as income, but it's a deduction in my end. So this is why you will see people say, "Hey, you can actually make your vacation a business. You can actually find a way." I always tell my clients, be creative, right, about your expenses. And what I mean by being creative is, if I go to Atlanta, I'm gonna see if I could sit with Uncle Charles. I'm gonna say, hey, Uncle Charles, you and your wife are busy. Let's do brunch, and we're going to talk business, right?
Yeah.
I'm not from the DMV. So we're going to talk business. We're going to talk about probably the come up. We're going to talk about what's going on in my firm. I always try to get some wisdom from Uncle Charles. So then if I'm at that trip and I meet a couple of traders there, and we also discuss trading under an entity, whatever the conversation is, I'm going to find a way to make half of that trip a business trip, or even all of it for that
Yeah.
matter. Like when I stay at the W's, I usually talk to the manager. For some odd reason, the manager always has some tax questions for me. So we're
I
going to
mean,
make this trip. So be creative when it comes to the expensive. So the
yeah.
Augusta rule is very simple. You able to use as much as 14 days of the rental as income, but in the business level, it's a deduction.
Gotcha. So what about, one of the things that we're looking at doing for my friends, we're actually having a Friendsgiving, right? But my friends and I, we own a company together, right?
Mhm.
So for that Friendsgiving, we're getting an Airbnb, we're having Thanksgiving, we're having a caterer. But again, the primary reason, of course, is number one for business. So it's our end of the year planning. Right. So that's another tax deduction as far as a traveling trip. But at the same time, I'm able to spend time with the people that I was going to spend anyway. Right. So we make that a full mastermind event. We go over our business financials for the year. We do everything planning for going into 2024. So now, again, you got, like you're saying, being creative is okay, doing the things that you were already going to do. But okay, how can you bring people together to talk about business, that get business handled while still on vacation and enjoying yourself? I
So
think that's
here's where you have to be very careful about that. And even like we find a lot of gurus and we find a lot of influencers. They talk about making everything. The idea of paying zero taxes.
yeah, it can't be everything.
Everything. Like get rid of that. Okay. You live in
Yeah,
a country where you pay tax, but there are ways to be creative. So, but when you say that, do not call it a Friendsgiving. Call it
yeah,
for what you wanted to call it. You just said we're going to do a mastermind class. Call it that. Because
yeah,
the minute you give it an identity, the minute you give it a name, that's what IRS is going to look at it. So when you
absolutely.
say, hey, I'm going to make my birthday, we're going to deduct my birthday.
You
Don't
can't do it.
say you can't do it. But if you say, hey, we're going to deduct this mastermind class, and I'm going to
Yeah,
have all my friends over. Listen to the terminologies that I'm using. Hey, I'm going to have this mastermind class and I'm going to invite all my friends over, because the minute you went and you hired that the minute you start having liquor, right? How are
yeah,
we paying for that liquor? How are we paying for that catering, right?
yeah,
Are we using the business card? And then I say yes, be creative, but also be ethical, because there's a difference between there's two type of expense. Right, both of your expenses needs to be two things, right? We said they need to be what is the term I'm looking for? Um, ugh,
if you're going to go tax code like 162, right? What it says in 162, those three items.
let's see.
Right. And that's a good thing,
No, wait. They need to be ordinary and they need to be
Yep.
necessary,
Yep.
right? So is your birthday ordinary and necessary towards the business?
No.
But the mastermind is.
Yeah. And
So
then and we do it for that end of the year planning, right? So it's a full planning session that we
I'm
have,
hoping
right?
I'm getting invited to this mastermind, but I'm just saying. So,
Yep.
but it's the way we present. It's the
Yep.
terms that we use.
And
So
the
if you have
documentation,
a tax strategist,
I'm talking about that documentation part, that part of
correct, it's documentation. So then
minutes,
when I'm doing that receipt, I'm making sure, hey, listen, it's my birthday, but the way that I want to celebrate my birthday is to have a get together and teach.
yep.
You see how I'm saying this? So, but to just say it's my birthday and I'm gonna write off my birthday, come on, we can't
Yep.
do that. So the idea of you saying it's Thanksgiving and I'm gonna write off my Thanksgiving, no, you're gonna write off this get together, this mastermind get together.
Yeah, and
So
I think also the documentation part, I think is huge on a lot of the tax strategies that you may hear online. Is also okay. How is that documented, right? I know one of the biggest things that we focus on, not just written notes in our minutes documentation, but also with videos and pictures, right? So we're going to make sure we have a photographer and they're taking pictures of us while we are working, while we're going through our events, while we're going through our slides, so we can show, okay, if the IRS comes to audit, okay, we have to show visual proof, right, with time dated stamps or
yeah,
time stamps. They
yeah,
can show, okay, this is what we did, right?
yeah.
I mean,
Yes.
so I think that's the biggest part when it comes to tax strategies or you living a tax-free life. You can do a bunch of strategies, or somebody can say that they did that on a on your tax filing, but what do you have to back it up, right? And I think that's the most important part, is that documentation, how to do it, where to keep that up with. So I guess that's a good point. So where do you feel that people should be documenting these type of things throughout the year to get better prepared for tax planning? What's the best way to do documentation on the different tax strategies?
On your books. Keeping books is so important. Like QuickBooks Online, you can QuickBooks Online. You can use Zero. I say if I had dinner with Chris, and we discuss Redline, I'm gonna get that receipt. I'm gonna sign it. I'm gonna date the receipt. I'm gonna have Chris signs the back of the receipt. So always use the when, where, who, what. Right? When did we have this? What did we have? What was discussed? When, where, who, what, in the back of your receipt. And here's the thing: like in my Discord, this week, you know what we discussed? We discussed the whole aspect of audit, like how to audit self, how
Yeah,
to audit yourself, how to audit yourself as a business. And the best way to audit self is to understand, how does IRS audit you?
yeah,
The way that your returns get audited is really simple. So your return goes into an electronic system, right? When it goes to the electronic system, anything that is not aligned, right? Let's just say you received the 1099B from your brokerage account, and IRS received that 1099B. But on your tax return, you don't have a Form 8949 and you don't have a Schedule D. So what's going to happen is it's going to swing a red light. Now your tax return is taken and it's put in somebody's desk, and it says review. So that's process number 2. It goes to a process. Now, once it's sitting, that person's not going to look and check mark all the errors that they find. Now that person has the right to go back 7 years.
yeah,
So that person now found an error in the first one. They go back from last year, the year before last. Then they say, oh, there's a pattern here. This person needs to be audited. It's literally that. It only takes one error, just
yeah,
one error, for you to actually get audited. So when it comes to your receipt, I say 2 things. One, keep all your receipt. Keep all of your receipt. Literally, all you have to do is create a file, name it. Name that file, right? And anytime you have an expense, you have the receipt, you just take a picture of that receipt and throw it into that file.
yeah,
If you're keeping books, I still say keep file of your receipts. Here's the reason why: is let's just say you went to the gas station, right? You went to Shell gas station and you pump gas. You use your business card. You pump gas for $100, and then you went inside the gas station and you bought a pack of beer and you spent $20. Now you spent $120 at Shell gas station. So in your bank statement, it says 120 Shell. It never indicate how much was for the beer and how much was for gas. The
yeah.
receipt explains the transaction. The bank statement only identify a transaction was
Didn't
made.
happen. Yeah, and I think it's just like we're such in the habit. Like how many times we go to a restaurant, we go out to eat, and we
Yeah.
take a picture of our food,
Yeah.
right? Like so we have a habit of taking pictures of our food and every time we go eat, right?
Yeah.
But we have to make it a habit of every time we make a financial transaction, especially if we run a business, you gotta take that picture, right?
You got to, yeah.
It's right. Again, and there's so much technology that we have that
Oh,
there's no reason why you should not do that, right? And it'll file it for you, have a system for it. But
oh
I
yeah.
don't think enough people talk about that documentation. And I think for me, when I was making a transition from corporate America to having a business, when I really understood documentation when it comes to a business trip, working corporate America, right? Because when you go on a trip in corporate America, right, they're going to give you a spending allowance, right? They're going to give you, say, hey, look, you can spend $25 per meal per day, right? So maybe you have 3 meals, you have an allowance of, of $75. So for the day. But when you come back from that trip, they want to see every single receipt. I used to have to put the whole packet together,
Oh yeah.
right, of all my receipts, right? For the
Yes.
company, right? But before we had every single receipt, every transaction, the hotel, we had to do everything in order for us to get approved. And if we had to pay out of pocket, that was the only way that we were going to get reimbursed. Is
Yeah.
every single transaction had to be listed and documented, right? So when you get in that type, like, man, that's the part that I used to hate. Like, I already been on this trip. I don't want to think about every single time, right, that I did that. But it was so critical when I started my business, and that's why I got good at it, because I remembered in the real world, Like, this is not extra because this is what major corporations are making their employees do every single time that they have a business trip,
Mhm,
right?
mhm.
So it's important on that documentation.
Oh my God, I couldn't agree so much. One of the things that I do with my clients is that, let's just say you don't keep books. So let's just say your business is not big enough. You're just a 1099.
Yeah,
Growing up in Jamaica, let's talk about you. Let's just say, you're just a 1099. You don't keep QuickBooks Online. You don't keep Zero, right? You're not in those two. What I would probably recommend is create a spreadsheet. Go to Excel, create a spreadsheet so you can allocate your expense, right? And in your spreadsheet, you and name what your expenses are. And every quarter, pull up your bank statement with a highlighter, realistically, and highlight those expenses and then allocate them. So at the end of the year, you have your spreadsheet. You turn in your spreadsheet to your accountant, so your accountant actually have an idea. Okay, she spent $200 in traveling, or she spent $500 in gas. Tow was $150. Oh, okay. For She purchased a laptop. So you can do this manually if you don't want to. But bookkeeping can be as easy as $25 a month, guys.
yeah,
Not for somebody to keep your books. Now, you may say, I don't know how to keep books. That's okay. If you're running a business that are running $50,000 or more, I say you need to hire somebody.
yeah,
But if you're running a business that's not as much, or if you are a 1099, and 1099 is going to also depend on too, because I have clients that are in 1099 that makes 400K. So then when you're looking at the 1099, if you 1099 and you're making $100,000 a year, I'm going to say get out of that 1099. Create an entity for it, create an LLC for it, elect as an S corp, put yourself on payroll, so then that you are not paying that self-employment tax, that extra 15.3, because 1099s are the worst. They get taxed the worst.
yeah.
They do. So growing up Jamaica, you say, for us to spoke on that. Yeah. So the strategies that I highly recommend for you is simple. Are you making more than $50,000 a year? If you're reaching the 50, 60, 70, 80,000, even if you reach 100K, I'm going to give you a perfect example. And I wish she was here. I had a client came to me last December. She was making about 300, 400,000 a year, and she was a 1099, and she had to pay over $58,000 on taxes, and it aches me. So I said, okay, this year you're gonna pay that, but now that you have me, you'll never have to pay that again. So what we did was we created an LLC for her. We elected as an S corp. We put her on payroll. We had her put some money in SCP. She continued to put her Roth. You want to know, when we're done with her planning, how much she has to pay this year? 7 to 8 thousand. So if she could go from 58,000 to 78,000, then we've done our job. And this is why planning is so, so, so important. But she had to do some things. We had to make some changes. So there are ways. It's just you have to be careful with the ways. I heard this man on Instagram say he pays zero tax. I was so interested to know what it is that he do. He said he pays zero tax. And he does. He doesn't pay any tax. But listen though, he didn't tell the whole story because I had to get the whole story from him. So he didn't tell the whole story in his video. But what he does is he gets paid, right? He has his business. The business pays his 501c3, which is a nonprofit. The business is owned by the trust. The trust is owned by a 501c3. He doesn't obtain any income. So I asked him, I said, okay, how do you pay your bills? He says, oh, my wife pays the bills. I said, so her income pays the bills. So the reason why you don't pay any taxes is because there's no income coming to you. So make sure that, because in this country we live, whenever that we're earning anything, right? Whenever anything is coming to us, we got to get a piece of it. So the reason why he didn't pay any tax, because nothing's coming to him. The money's not being moved anywhere. The money is sitting right in the trust, right in the 501c3, which is a nonprofit organization, which he doesn't have to pay any federal taxes on. So that makes sense. So when you hear these stories, you need to hear the whole story. The idea of just paying zero tax does not exist. It doesn't.
It's gonna come out somewhere, huh?
It's gonna come out. Listen, then why do people move?
Yeah.
How does depreciation works? How does depreciation work when you sell the property? Well, It's easy. There's no more depreciation. Once you sell the property, you are going to pay capital gains in the tax, depending on how long you kept the property. So once you sell that property, then the Form 4656 is closed. So the depreciation is closing that property. And then you'll just be paying capital gains depending on, again, how long you had the property. And was the property a residential? Was it a personal property, or was the property just was it a rental property? But the way that depreciation works on properties is depending on, for rental property, is one, you want to make sure that did you purchase the property as a whole? Did you have to put work into the property? I usually tell clients, when it comes to real estate, never buy anything that's finished. Never buy anything that's finished.
Yeah.
Because you can actually depreciate a lot more in the items, in the things that you put into.
Yeah. So what about performing a cost segregation analysis on that as well?
Yeah, you can do that as well. You can do that as well. But for the depreciation on the property that you sold, is going to be depend. There's no more depreciation once the property is sold, and it all depends on what kind of property. Right. You don't want, you guys say that, but y'all really don't want, you don't want Trump CPA. You don't. You want to know why you don't? It's so funny because everyone that works for Trump go to prison, but Trump. Everybody goes, all Trumps, except for Trump. No, thank you. I already said no, thank you. No, thank you. Y'all don't want Trump. Y'all do not want Trump's CPAs. Trump CPA. And it's so funny because when you do researches on Trump CPAs, realistically, he's so smart. Trump is so smart. Trump should have been a CPA himself. So he doesn't pay them. Trump never pays nobody out of his pocket. So what he does is he actually comes up with a game plan with them. He says, hey, listen, you're going to handle my books, however way, shape, or form. I want you to handle my books. I will pay for your daughter to go to school.
Yeah.
Or I will pay for all of your vacations. I will pay for all of your vacation. I'll buy you a couple of cars. Just do as I told you. Trump hilarious.
That's good stuff. What else we got? So I guess another thing I was going to bring up just on, and again, this is going to be a session that we can kind of grow on, is just even with tax loss harvesting towards the end of the year, right? This year you may have positions inside your portfolio that you can perform a tax loss harvesting event, right? So again, what that means is that, let's say if you have a position inside your account that you see that is a loss, right? Abby, you're the tax strategist. So you can go up, claim up to $3,000, right, per year in a loss, right? If it's under your, what's different if they're married? Is it both or 1,500? I think it's 1,500.
For what type of
married versus single on losses, capital losses?
Capital losses is the same.
Same, right? Mm-hmm. All right, so that's one thing that you can kind of focus on. If you're, I don't know if some of you guys are manage your portfolios. Like for my clients personally, we do those tax loss harvesting calculations. We go through the portfolio, those whole analysis. We actually do the tax loss harvesting for our clients, right? Mm-hmm. To get prepared towards the end of the year. And I think that's another, good strategy that you can actually use to actually prepare for tax planning. Okay. So you want to be able to look at your different positions inside your portfolio, understand, okay, what's at a loss? What can I move into? Okay. And there is a rule, right? You can't say, hey, look, I'm going to sell one company and go to a similar company within 30 days, right? Right. So we need to make sure that we understand the rules on that, on how tax loss harvesting works. But that's just another strategy that you guys can really focus on towards the end of the year with your portfolios. If you see that you have losses, to go ahead and capture those. And then some of that can be pushed over into the following year. So if you have more than $3,000 of losses, correct, Gabby, right? That can be pushed over to the next following year. You can kind of go a little bit more in detail with it. I'm on an investment side, so of it. So
When it comes to what I would say is be careful when it comes to your capital gains and your tax loss harvesting, because that can trigger a wash sale rule, right?
Yeah,
So what you want to make sure is whatever that you are selling at the end of the year, that you wait 31 days or more before you repurchase that security. So
yeah,
let's
that
just say
same security or a similar
or
security, right?
similar security,
Right.
correct?
That
So
same or similar. You got to be careful on that.
correct. You got to be very careful. So let's just say I purchased ticker Apple, and comes December, I sell it at a loss. I need to wait more than 30 days to repurchase the ticker Apple. And the reason why IRS came up with the wash sale rule is because what was happening is that the big dogs, what they would do is they would wait till December 31st and they would sell everything, right? And their portfolio, and they would sell it back. Once January come, boom, they repurchase it. And IRS was like, that's called double dipping. So I
Yeah.
was like, say, no, you need to wait 31 days before you can repurchase that security. So one of the things you want to also look into when you receive your 1099B from your brokerage account, it will show you how much money you spent in wash sale. It's
They
and people
calculate it for you. Yeah.
they calculate it for you, because once you trigger it, the brokerage account is the brokerage company is going to actually calculate it for you, and you pay it, and you don't even know you're paying it. So you want to make sure that you're not triggering the
Yep.
wash sale rule. So when it comes to your capital gains, you can write off $3,000 up to 7 years.
Got you.
So up to 7 years. But if you elect the mark to market election, which is not for investors but for day traders, if you elect the mark to market election, it what you call it, the wash sale rule. So you do not have to worry about the wash sale rule. You can purchase and sell a security at any time. But with mark to market, you are subject to paying taxes for the capital gains based on the fair market value. So regardless if you sold that security or not, you will still be taxed on that gain. So if I
Gotcha.
purchased ticker Apple and I didn't sell Apple, I kept it, and I have a loss, I can write off the total net loss. So I'm not, what's the word? So if my loss is $20,000 for the year, I can write off the whole $20,000. It
Gotcha.
doesn't have to be 3,000. But if I have a huge gain, I'm paying the fair market value of that gain, regardless if I sold that security or not. So it has its pros and cons.
I got you.
Yeah. Definitely. But yeah, I would say if you are an investor and we are in November, review your portfolio. Look at things that um look at things that are not cooking, they're not doing anything, that's just sitting in your portfolio for no reason. It might be time to sell it so you can write off that loss. You can write off that
Good
loss.
stuff.
One thing too as well, I know also talk to your CPAs or your accountants. Look into credits. I love credits. I prefer credits than deductions.
Really? Come on.
I love credits because credits lower my tax bill, whereas deductions just lower my net income.
Mm.
So if my tax bill is $20,000 and I have a $10,000 credit, that's going to lower my tax bill $10,000. Whereas the $10,000 deduction is only lowering my gross income, right? So look into energy, anything that is energy related. Look into electric vehicle. Like one of my clients, I told her, okay, yeah, it might be time for you to buy your Tesla. Let's take advantage of that credit, and let's not only purchase the Tesla. If she use it 50% or more in her business,
Business.
let's use the bonus depreciation. Let's use the bonus depreciation, right? The bonus depreciation this year is 80%. So you can actually deduct 80% of the cost of the vehicle. You can depreciate 80% of it and get that credit. That's a win-win.
Yeah, that is. I think we see like a lot of these things that we're pulling up. I think we should probably just have like a good show just on each one of those, because even that strategy right there is huge, and
It's
people
huge.
got to get it right. And that's why I feel like everybody, they should, for that tax portion of it, they have questions, they need to call you, right? They need to go through that with you. If they don't have a tax strategist to, to understand, okay, how should we put these things together? They got to give you a call,
Oh,
So if
yeah.
you guys are out there and you have questions like this, because a lot of times on our show, we're going over points, but now you got to understand, okay, how does that really fit into your personal plan? And the best way to do that is to give us a call, right? Or get a time on our calendar, or send us an email. So that way we can understand, okay, how does your full game plan work and what should we do?
Oh yeah. And I tell people it's so important to sit down. Sit down. It took me 2 months to put together my client planning because we had a lot. We needed to clean these books. We need to make sure that we put a plan together that made sense. Because we don't want her to have to pay a lot in taxes.
Yeah.
So yeah, I highly recommend. Our books are open. I'm not sure about you. Our books for 2024 is open. We are accepting about 200 clients. Once those 200 clients get there, we close our books for the year because we like to take care of our clients. So our books are open for a maximum of 200 clients. I do want to answer Lady and Mauve question here. She said, I have or had an LLC estimated in 2020. I haven't done anything with it, such as selling products. As long as it's still active with the state, can I still use it for some write-off? Well, as long as those write-off was expense towards the business, you absolutely can. You would need to just complete your Schedule C with your 1040, and in your Schedule C, you would enter your deductions. And since you didn't make any money, you can enter your deductions. Now, IRS allows that if you're running a business, right? You have up to 5 years that you can write off as a loss. After 5 years, IRS considers that a hobby, not a business.
Gotcha.
Because the whole idea of the business is for you to make money. So if you're not making money, then it's a hobby. So I would say after 5 years, if you sit here and all you keep doing is writing a loss, it doesn't look good in your books. Does that make sense? Hopefully that answers the question for you, lady. Yeah. So you can definitely you guys have my website. Go into my website, schedule a discovery call. Let's talk about 2024. I'm excited about 2024. I'm also I would not say worried. I'm a little bit concerned. There's a lot of I wouldn't say fear, but there's a little bit uncertainty about 2024. But that's like every year, guys. The people that does really well, the people that know what their goals are, what is it that they want, and they go after it. This is how we feel about every year towards the end of the year. It's nothing new. Nothing.
Every time.
Every time. I'm always can't wait for the year to be over. Realistically, the same thing that took place this year is going to take place next year. We're just going to be working, living our best life, and walk in our purpose, right?
That's it.
So definitely, guys, let us know the questions that you have. Let us know what you want to know, and we'll make sure we that takes place here for you.
Yeah, give us a full scenario, right, of what's going on, and we'll bring it up and we'll discuss it and handle your situation right on the live. Of course, we'll value your privacy and stuff, but at least have the numbers together so you can see us going through a full strategy.
Definitely. Well, that's all that I have for you guys for tonight.
Come on. Good deal. I think we did well. So so again, just reach out to us. We got a good show planned for next week. We're gonna kind of, for the rest of November, we're gonna kind of keep this same theme on tax planning and get some examples going. I was trying to get my program to work, but the example that I had was not good enough for, I guess, visual purpose. Yeah, I'm gonna get another W-2 so I can make that happen.
Next week, definitely. And I'll see if I can get a guest speaker in here for you guys.
Yeah, that'll be perfect. So I'm Christopher Bush, your financial advisor.
I'm Abby Joseph, your tax strategist.
And we are the Red Line.
Thank you so much for joining us tonight. I will see you guys next Wednesday. Bye.
Bye, guys.